that we as advisors are able to deliver the type of product that an individual requires and the type of risk that an individual is willing to accept. And we have to quantify that because risk to you and risk to me are two different things.
Welcome back to another episode of Angels, Exits, and Acquisitions. I'm your host, Jeff Barnes. This is the Angel Investors Network podcast. And today we bring you a special treat. Scott and Patrick are with Whitestone Wealth Management, and we're going to be talking about investing in alternative investments and some really unique ways to do that. That maybe is not startup investing, but there are other types of equities out there. And I think this is something that anybody has any substantial portfolio, $500,000 or more, is really going to enjoy hearing how these gentlemen analyze risk, analyze returns, and how you can start building a portfolio that's going to last for decades, if not generations to come. So stay tuned. And as always, give us a thumbs up and share this with anyone you think would benefit from hearing this incredible information. Thanks so much.
Welcome to Angels, Exits, and Acquisitions, the place to learn how to fund, scale, exit, and massively profit as an angel investor or entrepreneur. Brought to you by the Angel Investors Network. And now, here's your host, Jeff Barnes.
Okay, welcome back to another episode of Angels, Exits, and Acquisitions. I'm your host, Jeff Barnes, and we have a very interesting podcast for you today with Scott and Patrick. And Scott, Patrick, welcome to the show.
Thank you.
All right, so you gentlemen run Whitestone Wealth Management, and this is going to be a real treat for a lot of our listeners because we don't have a lot of wealth advisors and managers on here, and you guys focus a lot on alternative investment opportunities and whatnot. So why don't you go ahead and give everybody a little bit of your background?
Okay, I'm Patrick Lynch. Basically, I got into this business in 1981.
Okay, I won't tell you where I was at that point.
Okay, I wish I couldn't tell you where I was. Anyway, so at that time, I was sort of trained on the concept of modern portfolio theory. And that just basically takes all equities and shows what happens in different types of markets. And that was supposed to be the holy grail. We went through some really rocky markets, and that proved to really not pan out. And so I started looking for other ways to manage assets. And anyway, so we came to what we're doing now, which is a very process driven type of planning that we do for clients, and we're not for everybody, and we tell people that up front. But if you want to see what we do and how we do it, we'll be glad to show you that. We'll be glad to introduce you to that. And Scott and I and this iteration of this company, and my business partner, who's a CPA, we got together in 2004 and established Whitestone Wealth Management. And Scott brought a tremendous amount of technology to what I had been doing prior to that. And what we tried to do is we try to find the best managers we can. I believe that in any profession, about 5% of the people in that profession excel at what they do. The other 95% are average or below average. So what we're trying to do is seek out that 5% that can do it better than anybody. And we're trying to find out if we can quantify how do we establish a real risk return analysis. How many units of risk do I have to take to get a certain return? And that's what we're trying to do. So, Scott, go ahead. I don't want to take up all the time. Go ahead and tell us how you kind of bring your technology to bear on this.
Yeah, so I kind of came from the brokerage side of the world. I started at Merrill Lynch, went to Morgan Stanley, and then was recruited by Steve and Pat. to kind of come over, and they were much more planning based. And like Pat said, I really just kind of wanted to take his process and be able to do it quicker, right? So, like part of what Pat would always do is he wanted to look at relative uh, performance ranges. So, like the worst performance might happen from the 15th of the month to the 27th of the next month, right? It's not a rolling month, or it doesn't happen the first to the 31st. It's not clean like that. And Pat was basically figuring all this out by looking at newspapers, and it ended up with black fingers. And I kind of came in and said, we can build an Excel spreadsheet that'll do most of that for you.
I do want to interject. They did have electricity at that time when I started doing this.
That's
Okay, go
fair.
ahead, Scott.
And so what we did was bring in Excel, right, into it, so we could put in a day, calculate a day, and then download returns and look at it a different way, so that we could, instead of just trying to, most places when they are looking at managers, they're looking for relative performance. Does it match an index well? Things like that. When we look at a manager, we want to look at all the risk periods possible to determine if that manager has a process in place to manage risk. And we do that by kind of looking in at very short relative periods where we can line them up and see who had the best, not the best performance, but the best risk management over very specific periods. And then that way we can uncover not just who's the best or who's the worst, but who has a process. That's more important to us than relative performance, or they did really well during COVID. It's more about they have a process that's repeatable, and we can show on paper that they have a process that's repeatable.
So a few things I want to unpack there. And Patrick, you had mentioned modern portfolio theory. Why don't we discuss what that means first before we go into some of this more technical stuff that you guys were just touching on?
Okay. Modern portfolio theory is a concept that was created by a gentleman named Harry Markowitz, University of Chicago. Very bright guy, very smart. And he basically said that if you take all equities and you divide them into their subcategories, small cap, large cap, mid cap, growth, value, etc., that there should be some non-correlation between those cap sizes. In other words, large cap might be going up and mid cap might be flat or going down. So and if that is true, if that is the basis of your analysis, then that means that you should have some buffering effect inside of your portfolio. In other words, you don't want everything going up at the same time, because what will happen?
I'll go down at the same
It
time too,
all
right?
goes down at the same time. Exactly. So, according to modern portfolio theory, that's not going to happen. But what we found out, and it's always a gut punch, but what we found out is in the worst of times, whether it was '01 through '02 or '08 or whatever, you lose that non correlation. Everything goes down, everything gets smashed. And that's not what I want to deliver to my clients. I can't deliver that to my clients. Um, and whether we're talking about multimillionaires or people just trying to retire comfortably, you have got to avoid that at all costs. So that's
Right.
that's my explanation of modern portfolio theory. It has some extremely good qualities, but we moved on to something known as the endowment style portfolio.
I like it. Yeah, and it's interesting because when I was 18, I decided to join the Navy, and my great grandmother had set money aside for me to go to college. Well, join the military, don't need to worry about going to college; they'll cover it. And as a result, she ended up gifting me this portfolio of roughly, it was only about $25,000. Um, but at the time, this was the late '90s, and we said, "Hey, you know what? The tech bubble is still hot, and let's do this and let's put money in." I did, and I watched it. I watched about 30 to 40%
Oh,
disappear pretty quickly,
yeah.
which was my foray into actual investing and realizing, man, I don't like this idea of not having any control over my investments and my portfolio. Hence the reason that I have my book over here, this one over here, the ultimate guide to self-directed investing, which is all about, choosing alternatives. And, what you guys are just hitting on was, listen, we don't want to just follow the herd, so to speak. And you went into a much more meticulous method of analyzing risk, and risk adjusted returns, I think, is really what you were getting at there, right, Scott?
Yeah, absolutely. When you, if you think about what we're trying to do when we examine all these different risk periods, is in a sense, we're trying to find someone who's doing something different as the index is having its worst performance, right? Because virtually we judge that based on the performances of the indexes across the board. Like Pat kind of said, when the market drops 20%, typically, so is your small cap, so is your Dow, so is your tech, right? They're all going to have these all minimally relative performances. And so if we can judge them based on that period and find the manager that is doing something different every single time or 95% of the time, that's what we're looking for. The guy who's doing the opposite when benchmarks are doing their worst.
So how does this play into investing in alternatives? Which why don't you guys go ahead and define what alternatives means to you and why somebody might be interested in something like that?
I would say that to us, an alternative is not stocks, bonds, and cash, right? Most advisors, when you go interview them, they're going to give you their interview as a questionnaire, like 8 to 10 questions that says, how old are you? When are you going to retire? If given these 4 choices, which would you pick? And then they add up your points and they say you're a moderately aggressive investor, right? Or you're an aggressive investor, and they get you into a pre-designed portfolio. Our version of that is your cash flow should determine your risk, and every asset that we invest in deserves its own timeline. Just like if you came to me and said, Scott, here's $100,000. I don't need this for maybe 20, 30 years, maybe never. I'm not going to invest it in a money market account. And vice versa, if you come to me and say, Scott, here's $100,000, but I think I'm going to need this money back probably in a year, then I'm not going to put it in real estate or private equity where we can't get back to it in a year. And so every asset deserves a timeline. So as we define the person's cash flow is what determines how much public equity should we have versus how much private equity we should have, how much private debt versus public debt, how much of this needs to be liquid. And then we do the relative analysis within each category. So, Pat, we're kind of talking about equities, right, to begin. So we'll look at just how we should manage this equity portfolio, and especially in regards to what you have elsewhere. A lot of times we want to start with the assets that we can't manage, right? Like if you have a 401k, not to pick on anyone, but like the government has the TSP, right? That really only has like 5 options plus a mix of lifestyle funds. And that's it. And so we have a limited list to work with. Our work on the side of the advisor should be complementary to that in designing their overall portfolio and determine, should we take the risk in their 401k? And because those are equities that we can't really change much, let's just get exposure to indexes, and then do something completely opposite on the private side in your personal IRAs or in your brokerage accounts. But it's really up to the person's cash flow to determine what mix of liquidity and illiquidity they can handle. And that determines how much of that can be alternatives. Because typically when you think alternatives, you think non-liquid. And it's changing a little bit today. Some of the non-liquid products are liquid quarterly, or they have limited liquidity. But all at once isn't really a thing in alternatives.
Absolutely. Yeah. So Patrick, this is a major departure from what you would say is maybe the modern portfolio theory that was developed decades and decades ago. But we are finding that a lot of people are sort of waking up to this idea that, hey, you have the Grant Cardones out there and you have all these people that are talking about real estate. And so there's a lot of attention towards real estate. Now people are saying they want cash flow, and you have Forex traders and of course private equity fund managers. And we hear, these private equity multi-billion-dollar portfolios that are out there and they're just crushing it. But the average investor, let's just say even $1 million in investable assets. Now, obviously there's a wide range. They generally don't have access to a lot of those. So how do you guys broach this subject with them to help them understand that this is a departure from what I was a financial planner for a little while and did exactly what you said, Scott. Let's fill out a financial needs analysis. Let's figure out what kind of insurance policy you need, and let's figure out which mutual fund to put you in. Again, not my cup of tea because I was a glorified salesperson versus somebody who really needed to understand investing. And so I imagine, and correct me if I'm wrong, but I'd imagine a lot of people come to you guys thinking, okay, I know I need to start investing for the future, but they're probably not well versed in all of these things you guys just talked about.
Yeah, exactly. I started using alternatives in the late '90s at the same time you were watching 30% of your portfolio go away, Jeff.
Mhm.
Uh, but at that time, and you hit on something very germane to the conversation, is that it is more difficult to help and manage someone's asset. Let's say if they have less than $500,000, because it's hard to get the diversification and the non-correlation
Right.
with a smaller portfolio. So, um, and they've made it so difficult today that it's also just difficult to work with smaller portfolios, just due to the structure of how that all pans out. But getting back to what Scott was saying, it's extremely vital that we as advisors are able to deliver the type of product that an individual requires and the type of risk that an individual is willing to accept. And we have to quantify that because risk to you and risk to me are two different things. The language is not perfect. Communication is not perfect. So we really have to drill down and make sure we understand these common words that can actually be many things to many people. Um, and once we know we have that understanding, then we can proceed. But what we've got to do is just wait and make sure that we're getting the right feedback from the client, which tells us that they're following along our process.
Before continuing, please subscribe and share this video to help us reach more people and stay notified of our latest releases. Now, let's continue watching and learning.
And how easy or difficult is it to do that? Because I can't imagine these people will just hand over their money and say, "Okay, I'll see you in a few years," or even every year at tax time, right? They're seeing stuff in the news that are affecting these things. They're probably concerned because a lot of people the number one reason that marriages break up, finances. The number one reason that a lot of people go into depression, finances, right? There's all these different things. So money is always top of people's mind, whether you have a lot of it or none of it, right?
Well,
And
you
so,
hit a great point there. Yes. Yeah.
yeah. And so I think that when you start educating people, hopefully you're putting their minds at ease that you guys know what you're doing, but there's still these outside forces that are saying, don't do this, don't do that, right? Because I mean, we hear it scream from the rooftop all the time. Um, you know, get a good job, put away,
Yeah.
at least 10% of your income, put it into the stock market, and you'll hopefully walk away with an average of 12% over the next 40 or 50 years. And if you did this right, you should retire well. And you guys are taking a different approach to that, which I
Well,
love.
that's exactly why I said in the beginning, we're not for everybody. And if I see that we are not, that the individual is too anxious, too nervous, um, and really isn't following, then I don't want to have that relationship. I'm not the type of advisor that person should be with. And we're very, I mean, we leave as friends. Hopefully, we met as friends, and but the process has to override all of this, and we have to be extremely careful of what we're delivering to the client and what does that client understand about what we're delivering to the client. And that's why I say that we go down this road and we may have all the best data you can have, but if it's not getting through to the person across from you, then we have an issue.
Right. Right. Well, now I want to talk a little bit about, and not diving too deep into the technical analysis, but I know this is a question a lot of people have on their minds these days, which is we've seen index funds and ETFs come up through the ranks and people just saying, oh, we'll just put your money in that. And now we're seeing AI kind of starting to dominate the financial landscape in general. What are some of your guys' concerns and things you guys are seeing in those areas? Are you suggesting people look at them? Are you guys taking a proactive approach to that, or is it something that you're saying, "Hey, listen, let's feel it out"? Because I'm hearing all sorts of noise in this space.
Yeah, I mean, it's definitely a trend you have to pay attention to. We try to encourage clients. Typically, it depends on the client's level of sophistication, right? We have some clients who would come in asking about specific stocks. Should I invest here? Should I invest there? A lot of the clients that we have, they just want to play the trends. They're not interested in getting into specific positions. They just want to be, I want to be in AI. And the way we don't do a lot of individual stock investing. We do a little bit, but it's kind of a different game. We're mostly trying to get to a manager that's going to have exposure. And the way that our process is driven, we have to trust the manager after we look at them, the way we analyze them. We have to trust that the manager is going to manage the risk well within that sector. So we might have like a private equity. We have private equity positions that might be able to invest in AI trends and data center trends and things like that. It's not as much us making the call. We'd rather have the person who's the money manager, who's going and looking at projects and seeing hundreds of them to make the best decisions. And then we rely on them to do the true endpoint investing of what companies are we invested in.
So this goes back, and I love that answer. Different than what I was thinking you were going to say, but you're going back to, as advisors, it's your job not necessarily to figure out the trades to make or the exact investments to make, but you guys are looking at the managers specifically and seeing what their overall long-term rate of return is, risk-adjusted rate of return, things like that, against other benchmarks and choosing hopefully the best managers.
Yeah, I really look at ourselves more as the client's advocate because we see so many things every day. Pat and I have 20 people every day leaving voicemails, knocking on our doors, wanting us to see their product, understand their product, and sell their product to our clients. It's our job to wade through the minutia and figure out which ones are right for our clients or which ones are right for any clients. There's plenty of products and things that have come along that we're like, wow, that's a really great product, but we've never used it because it's never been right for a certain client. We've just never had the right client come along to be the perfect fit for that product. And I think most advisors think of it the opposite way, where they find one product and they're like, man, I can sell that to everybody. So that's going to be a part of every single thing that I do. And they're not really matching a client with what's best for them. They're matching their products with the best way to sell it to their client. It needs to be the opposite way.
Right. Yeah. And you guys are a registered investment advisor, I'm assuming, correct?
We're not an RIA. We're a broker dealer. We go through.
Okay, you are the broker dealer. Okay.
But they have an RIA that we use. We use their corporate IRA is what I should say.
Gotcha. Okay.
We're an RIA, but through the corporate setting, not us personally.
So let's unpack that a little bit because I think that's really important for people to understand. I do want to talk about what are things that people should be looking at for their portfolio in general. But why did you guys choose the broker dealer route, and how does that differentiate you from the average Joe financial planner out there? Because that's a big thing.
Yeah, it just means that we have somebody looking over our shoulder all the time instead of us trying to manage ourselves. When we were looking, we weren't happy with the broker dealer that we were at back, when COVID happened. Unfortunately, we weren't able to go out and interview other companies. And so we had our time commitment is to our clients. And we felt that if we had to peel off and start doing our own compliance and putting reports together, and when audits come, they come in, we felt that might be too time consuming. And we'd rather spend our time with our clients or figuring out what's best for our clients. And so the broker dealer that we found was they they were agnostic to either. They were like, if you want to be in our corporate RIA, you can. If you have your own RIA, you can do it that way. But then having the broker dealer along with it allows us access to bigger relationships, right? That it's not just who walks in our office, it's who also walks in our corporate office. And corporate says, oh, wow, this is something that needs to be shared. Let's provide this to everyone. And so the only thing that I would say is on the broker dealer side, you probably want to be with a smaller independent broker dealer that's very reputable. Most of the problems that we've encountered in our career, and I probably speak for Pat, is the bigger the company that we were aligned with, the more problems we had. Because in reality, a broker dealer or people who are doing compliance, on top of you, in a sense, they have to cater to the lowest common denominator. And like I said earlier, if you have an advisor who finds one product and thinks it's the bee's knees and that's all they should use, that's what broker dealers are trying to guard against is a single advisor taking a single product and selling it to every single person they have. And so it's good for products, it's good for compliance, it's good for the clients. At the end of the day, you really want your advisor to be a fiduciary, and you want them to not be beholden to a certain company or companies.
Yep. I think that's really important. That was, again, one of those things that I learned along the way is like, I'm a glorified salesperson pushing a very small number of products that I didn't even believe in. And I realized I couldn't keep doing that. So that's why I wanted you guys to really hit on that, because it does make a difference when you start talking about taking care of your money and planning for the future. You go to a used car dealership and they're going to sell you the car that's on the lot. Come hell or high water, you're not leaving until you bought a car from their lot, whether it's a junker or not, right? Versus you go after somebody that's more of your advocate, like you were saying, and has a fiduciary responsibility to you not to lose your money, and they can look at the broader thing. Which brings me to the next question, which is, what are some things that when you guys are talking to clients, they've come to you, you're looking at their portfolios and you're finding maybe there's some gaps in their portfolio. What are some of those common things you're suggesting to people that they should be looking at as part of their portfolio?
Yeah, we always see stocks, bonds, and cash, right? A lot of that. We see real estate missing, which is a big part of anybody's investing. And it depends on their structure. Some people live in an apartment. Most people own their own houses. You might have a couple of rental houses, something like that. And so maybe we're building off of that. Private equities is another one that people don't have. People need to realize that the public markets are shrinking, right? I like to say there used to be the Wilshire 5,000 back in the day, had 5,000 companies. It was supposed to be a total market index. Well, today the Wilshire 5,000 would be like the Wilshire 3,600 or something like that. It's a smaller number. Companies are going private, or a lot of companies have merged, so that world is shrinking, or they're not going public longer, right? Think of the difference between, say, Dell Computers, which starts as a company, goes public, and then blows up and everybody becomes rich, versus like a Facebook where Mark Zuckerberg was like, hey, I'm going to keep this private as long as I can, grow it as much as I can, and then go public. And so a lot of your opportunity set is not publicly traded equities anymore. You have to go to the other side. And I would say real estate and private equities are probably the two most underrepresented categories that we mostly talk about. There are certainly others.
Well, I think that's really important. I mean, and quite honestly, that's an area that we've leaned into a lot over the last few years, because here I am running a company that helps startups raise capital. And you guys know the risk profile of those, right? And guess what? Most investors are not willing or able to put money into startups, which is totally fine. It's not, just like you were saying, Patrick, it's not a good fit for everybody. And so the private equity and the real estate, we're leaning into that a lot as well. But how do you guys get exposure to people when it comes to private equity? Because there's a lot of ways to go about it. In fact, we even coach and teach people how to go buy their own business so they don't have to be the operator of. But that's a completely different than being, part of a GP stakes program or getting access to a fund. So how do you guys go about that?
Yeah, I mean, a lot of it has to do with our broker dealer that we've chosen, that they get to interview all these companies and we interview them as well. So a lot of it is going back to the same process that we apply to like equity managers, we want to understand that there's a process involved of how they do it. Is it repeatable? And the other thing we kind of missed on that is not only can we find a repeatable process, but can we tie it to a set of people? What are the people that are involved in the process? And so even when you're talking alternative managers, the people are important, because those are the people pulling the triggers. And it's part of it is you have to get a feel for their business. You want to visit with them. You want to visit with the higher ups. Literally, sometimes you have to size these people up and just get a feel for them I don't know if that's the kind of person I want to be in business with. Forget about the product for a minute. If the person or what the process they're doing supersedes what the product is, then that's a bad thing. And so sometimes we have to be just judges of character. But the first part is it's got to be backed up with data. They've got to have enough history and have done it enough times that they can take this to companies and get on people's platforms. If they're just starting out, or typically that's not going to get through to us. You have to have done it over and over and shown that it's repeatable. Pat, you wanted to add something?
These, as Scott said, we have people knocking on our door all the time to come in and give us a pitch, but I have to hear this. I have to hear the pitch 3 times before I feel that I completely understand what they're doing. We also have to tear apart the prospectus. We have to, and that's the other benefit about having a broker dealer as opposed to being our own RIA, is that they also look through the prospectus. They also are doing their due diligence. Once they turn it over to us, we have to do our due diligence. But back to your question, Jeff, is getting exposed to private equity is it can be fraught with problems. And as Scott said, you have got to know the executives of the company. You've got to know how long they've been there, what's their track record, how many programs have they brought full cycle, and all of those things are important. And when we can, and if we like a program, before we will even start talking to our clients, we'll make some investment in it ourselves. And I think, I mean, after this Bernie Madoff thing, it just, you just want to be very careful and then take your steps after that.
Yeah,
But
absolutely. I think
yeah,
you couldn't have said that better. I mean, I actually, one of my dear friends and partners I still speak to every single day, raised a lot of money, was on track to take his company public. And turns out that the money that he had sitting in the bank account was in a Bernie Madoff fund, unfortunately. So that not only derailed his future, but all of his investors as well. So you can imagine how challenging that was. But definitely,
and he did that for all the right reasons, I assume. I mean, he was trying to get a little better return. The sheer audacity of Bernie Madoff was that he wasn't showing huge returns. He was showing a consistent 7 to 9% returns, and of course, those are believable. And again, it turned out to not be believable. So,
which is
yeah.
ironic, right? I mean, he could have been doing things the right way and been out of jail right now, and everything would have been just fine if he'd have actually kept his nose clean, right?
If everybody, these scammers, if they would all do things the right way, they could make a lot of money legally.
Yeah.
And instead, they go the other direction. So, yeah, good point.
Yeah. And the financial industry, unfortunately, is just fraught with these because people are looking at a way to get a quick buck and pull the wool over people's eyes. So it's good to hear. I mean, the thing that you just said, Patrick, I think is really important people to understand is you guys put some of your own money first into something. And I do the same thing when it comes to a new investment opportunity, something that's maybe untested and whatnot. Put your money in first. And I think that's also really important for the entrepreneurs listening to this. I know there's a lot of investors and business owners that are out there saying, okay, how do I get in touch with these guys? And we'll get to that in just a sec. But for those people out there that are looking on, they're on the other side of this coin that might be bringing an opportunity to you guys for private equity or anything like that. If they have not put their own money in and really run with that, or their own real estate deals and put their own money into their own real estate deals, that's my very first red flag. And that's the first walk away point, right? It sounds like you guys are pretty much the same way.
Exactly. Yeah.
Yep. So that's wonderful. So Patrick, Scott, thanks so much for being here today. Why don't you tell folks, actually, before I go to that, I have a question I ask everybody. I need to make sure I ask this. Knowing what you know now, you've been in this business for a very long time. You guys have been doing this. What would you tell your younger self who's about to take the leap going into this field? What piece of advice, one piece of advice you would give your younger self before going into this field?
Run.
The opposite direction or into it?
Run. It's an extremely difficult business in the beginning, and you have to. I mean, it was the hardest thing I had ever done. I felt like I was on a bamboo bridge, and both ends were on fire. And at that time, I had two babies and a wife and no income. And so anyway, that brought a lot of things out in me that I didn't even know were there. And it proved to be very, very good. But if you can get past the first 5 years, then the rewards of this business are great. The people and your clients are the rewards. You meet great people, you make wonderful friendships, and these friendships go for years. And I don't know any other business that's quite like this business. So I would say go into it with both eyes open. Know that you're going to have to put in a lot of work, but it's your business, and if you do it the right way, you'll be rewarded for it.
I like that. Scott, what about you?
Yeah, I would definitely echo with Pat that it's not easy early. I came to the business, a little bit different than Pat in that I thought it's what I always wanted to do. So as I went to school in finance and was kind of the nerdy kid and was like, I've figured out how to buy stocks and how to manage money. I'm gonna make so much money my first year out. It's gonna be great. And by the time I'm 30, I'm gonna have all this stuff. Um, and what I didn't realize is that I was getting into a sales business. Is that I didn't think it was going to be sales. I thought it was I show up and I show people, share my knowledge, and people are like, oh, okay, yeah, I'll give my money to you. It doesn't work like that at all. It's like the hardest part of this business is getting in front of people just to have the luxury of telling them what you do. It's not an easy thing to get in front of people um, just to get the appointment. And I tell everybody, we have a lot of clients who'll say, hey, what should my kid in school do? What should he try? My recommendation is always try sales because you don't realize how hard sales is. And even if you're not going into our business, right? Even if you're not going to be a financial advisor, any business that you start on your own, you have to do the sales part. And nobody talks about the sales part. And so I always tell kids, go get a sales job, a summer sales job, selling knives, or I did a summer job where I sold credit cards over the phone, right, at a telemarketing firm. And it was like, you get used to being told no and don't make it a personal thing. Too many people get in this business and they hear no, 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 and they can't stay long enough for the yes. And so practice sales, get good at sales, and then everything else comes naturally. And no matter what business you're in, sales is going to help you.
Amen to that, Scott. I love both those answers, guys. And I got to tell you, so, you know, both of you guys have said a variation of things that other people have said on this podcast. And I love hearing it because it reaffirms the things that I've learned over the years as well. The things that I didn't know I needed, which Scott, you just hit on it. I was an engineer. I was a knuckle dragon mechanic in the Navy. I was working on nuclear power. I was a submariner. I was as far removed of having to sell anything ever in my entire life. And then went into an engineering job and then the financial planning. I realized I was trying to avoid sales my whole life, not knowing how important it was. So very, very important. And Patrick, to your point, I think this business, you guys are in the business I'm in, entrepreneurship in general, it's not for everyone. It's definitely not. And the fact is that it's not easy, no matter what field you go into. And Scott, you just alluded to the fact that it's like, hey, I understand numbers, I understand charts, I understand finance, technical analysis, all this fun stuff. You do capstone projects till the cows come home, showing returns every single time that you're winning, and yet people still won't believe you, and you got to convince them, right? So it's challenging. It's great hearing you guys say that stuff, because I think it's just so important for people to understand this and go into any of these things with eyes wide open. Gentlemen, we've learned a lot about you guys today. I know there are going to be people out here that are going to want to know how they can get in touch with you and how they can do business with you. So why don't you tell us where they can find you?
Yeah, you can find us online. Our website is whitestonewm.com. WM is in wealthmanagement.com. They can reach out to us at our office at 210-341-1515. We're happy to jump on a Zoom call, or if it warrants, we can go to you. We've done a lot of business all across the country. We might be in San Antonio, but I've got a place in New York. We've got a place in Denver to go to, and even in Michigan. We spent some time in California too. So we're all over the place. So anyone can reach out to us.
All right, gentlemen, we'll make sure we get all of that information in the show notes. So if you're watching this on YouTube or any other, listening on any other podcast channel, make sure you check out those show notes. Go connect with Pat and Scott and learn about Whitestone Wealth Management. And by all means, even if you don't work with these guys, understand the principles they just laid out here today, because it's so important for your future sanctity, as well as your legacy and the ability to build your own wealth and nest egg for a lot of folks. So Scott, Patrick, thanks so much for being here today.
Appreciate it.
Thanks a lot,
Take
Jeff.
care.
It's nice to meet you.